Millions of Aussies invest in the share market, but it's not the only way to put your money to work. Yes, the share market offers potential for high returns, but that also comes with an extra bit of volatility. That's where global private credit comes in, one of the fastest growing asset classes in the world over the past 15 years. Global private credit is a form of non-bank business lending on a global scale, and it is much more diversified than Australian private credit. Investors can access steady and attractive income with lower risk and better returns than traditional fixed income asset classes, whilst avoiding share market volatility. There are limited global private credit providers in Australia. One option is Term Plus, a fixed term investment paying monthly income that's linked to the RBA cash rate plus a fixed margin. Term Plus target returns are tied to the RBA cash rate plus a fixed spread. Returns can be paid to your bank account or reinvested for compounding. Head to termplus.com.au for more information and to read the PDS. Remember to always consult a financial advisor to find the best fit for your financial circumstances and goals. Jason, welcome to the show.
Thank you, Owen. Good to be here.
It's great to have you in Melbourne, and to be able to do this in person is extra special for me.
Of course.
We were just talking off air a little bit about your career.
Yeah.
And I'd love for you to take us on a bit of a journey.
Mm-hmm.
Like we know we'll talk more about, factor investing, indices, all that sort of stuff and what you're doing now, but how did you get here?
Yeah, good question. And it's great to be in Melbourne back, right? So I started my career really like from the asset management side. So I think maybe take a step back. I did my school in finance. My kind of major was more like finance, investing. And then after my undergrad, I went to States. I did another like master's in computational finance, which is more like financial engineering. You get a bit of statistics, a bit of computer science, maths with finance. Mm-hmm. Then after that, I want to get into the world of like quantitative investing. Mm-hmm. And I started my career in the US with an asset management firm that's focused on quantitative factor side. And I've been doing more like, factor research for 5 years. And in 2020, I traveled back, from the US back to China. I joined S&P Dow Jones Indices as a product manager. And since then, I have been, looking after some of our factor strategy indices for the APAC region.
Yeah, great. It's a really kind of, you've been around the world with your career, and you've done such good work. And many of the things that you've done, which we'll talk about in this show, people here in Australia have benefited from, right? So why was factor investing in particular interesting to you?
Yeah. So again, back to the school, right? So I remember in my sophomore or the third year in college, we were at a investment class. It's really like investment 101. And we were learning about this, capital assets pricing models. We were learning about how the empirical kind of research and asset pricing theories kind of evolved over the past 50 years. And remember, after CAPM, we talk about something on the Pharma French models, the factor models. And that's the first time ever, honestly, I heard about the name factor, right? And what it means in the finance and investment world. And then fast forward, as I moved to States and after school and work, I got a chance to work with Professor Ken French in my previous company. So it's quite, if you think about, right, reading and learning in the classroom versus, directly having some exposure, under that research environment. And that really kind of triggers my interest in terms of like how the factors work, what are some of the rationales behind this. And I think the thing really kind of get me excited about this is that there is as I said, asset pricing theory. There are a lot of empirical research, a lot of academic papers published, not only just, pharma's like efficient market hypothesis, but also a lot more in terms of like some economic rationales behind those factor designs, the reasons why they have that type of empirical result. So you get a bit of like science per se behind some of those like research results. And then in terms of the real world, if you think about it's very exciting to apply some of those academic basics, right? Some of those researches behind the literatures into the real world in terms of designing, factor-based indices and apply some of the factors that's been very well documented, researched from the academic world, like over the past, 50 some years.
Yeah.
So I think that's really kind of get me excited, and I can utilize some of the things learned to create tools to create like data that might be useful, helpful for the market participants, especially when they are looking at, how to measure a certain type of, performance or asset classes.
It's really interesting because we'll get into this, but you've kind of gone deep. Obviously, you talked about statistics before and all that sort of thing. Yeah. Us as investors, we kind of get a glimpse into what the work you've done primarily through ETFs, or we hear it on the news and those types of things. And like to give listeners a sense of this, things like, when you want to invest in high yielding stocks, or if you want to invest in broad-based markets, there's so much of that research behind the scenes that you just kind of take for granted and what actually goes in there. Question for you, how did S&P Dow Jones form, and like what's the role in the market today? Like you're based in China, we're here in Melbourne today. What's the role in the market?
So a bit of history about S&P Dow Jones Indices, right? So S&P Dow Jones Indices, it has a very rich in terms of history back to 1896. Oh, wow. A long time ago. So when Charles Dow, he created the first major index, which is Dow Jones Industrial Average, right? Yep. And S&P side, so Standard & Poor's company started to publish indices back in the 1920s, also very long time ago. Oh, wow. And the most notable one, right, we all know is the S&P 500. Yep. So the S&P 500 was launched in 1957. Right, 1957. And it has become the benchmark when it comes down to like measuring the performance of the US equity market. Yeah. In 2012, so S&P indices and Dow Jones indices, they merged to form the S&P Dow Jones Indices today. And that creates, one of the largest index providers globally at this point. So today, if you look at S&P Dow Jones Indices, we are part of the S&P Global. So S&P Global is a publicly listed company in the United States, and it kind of operates through several different key divisions like S&P Global Ratings. You might have heard about the rating surveys, S&P Global Market Intelligence, Commodity Insights, Mobility, and us, S&P Dow Jones Indices. So if you look at us, like S&P Dow Jones Indices plays a very important role in terms of in the global markets, that the service and the indices we provide, can be used as benchmarks for products ranging from index mutual funds, ETFs to futures, options in the derivative space. And about, I would say like 1/3 of the global indexed mutual funds are linked to the S&P 500.
Oh, right. I didn't know that.
Yeah. And more than 1/4 of all the ETFs out there around the world are linked to an S&P Dow Jones Indices. Huh. Yeah. So it's a pretty, diversified, offerings in terms, and we'll talk about that later in terms of our kind of indices. But if you look on the high level, it really kind of span across different asset classes like, equities, fixed income, etc. And we cover most of the global capital markets. So we talk about this, right? We also have indices for the Chinese market, Japan, Australia, right? So here in APAC, we actually have like local indices, not only just, US indices. Yeah. And specifically in Australia, we collaborate closely with the ASX to provide the complete range of the, performance measures of the Australian market. And that includes the headlines, the S&P ASX 200, the S&P ASX 300, right? So these are very widely used local benchmarks. But beyond that, our offerings also expand to things like, fixed income, sectors, factors, dividends, thematics, and other different indices. This year actually marks the 25th anniversary of the S&P ASX series and our kind of partnership with the ASX. So the S&P ASX indices have been really like a cornerstone, right, of the Australian financial market over the past 25 years. And it drives the growth of indexing-based investing in the Australian market.
Yeah, it's when you put it like that, like it's everywhere. Basically.
It's everywhere.
Yeah. And even things like the research, I think you call it the intelligence division, things like the SPIVA report, like active and passive.
Market intelligence. But the SPIVA report is generated by S&P Dow Jones Indices. So the market intelligence is more, they have a variety of services, but something like data, for example, and we also use their data products to create indices. Yeah, cool. Yeah, so our divisions kind of have, focus and specializations in terms of our product offerings. But SPIVA is like, for S&P Dow Jones Indices, we generate
right.
SPIVA.
Okay, yeah,
and we talk about that later.
Yeah, because that's so popular here in Australia. People always refer to that. So despite you being based in Beijing, you cover markets all across the world.
Yeah.
I guess there's probably a few things that I want to ask you about. Like, what are some of the differences or similarities as you look across the world?
Right.
And also, I guess, what are some of the things that the average listener or person that follows this podcast wouldn't realize?
That's a very good one. So actually, first, before talk about different similarities and prices, so as part of the S&P Global, S&P Dow Jones Indices, our footprint extends across more than 70 offices in like 35 countries. So it's really a global footprint, and we operate as a truly global organization, as our name suggested. S&P Global, our parent organization. And with that global footprint, it really enables us to attract some of the best talents from the local markets. So despite that, I'm Beijing based, but I cover, as you said, different kind of markets. We could launch indices based on different underlyings, but we also have product managers in Hong Kong, in Singapore, New York, London. So it's a pretty global team, and we collaborate very closely. So home office really doesn't kind of prohibit or limit what we can cover, what we can do. And in fact, I think it brings a bit more like, global perspective. And in terms of like the difference and similarities, I think one thing that, maybe it's surprising is that there's some consistencies across the market. Because if you think about the difference, it's very normal to imagine, different markets like China, Japan, Australia, by nature, they have, regulations, market structure. Even if you look at the headline index, the constitution is different, right? The sector weights are different, right? There are a lot of domestic characteristics. That's just the nature of the difference in the market. But one thing we found surprising is that some of the observations are quite consistent. So take one example, like in the factor research, right? In factor research, we sometimes do this thing called robustness checks. And that's very common in like academic literature. So if they observe some kind of patterns in the empirical data, they want to do robustness checks. Like if this thing exists in the US, does it exist in Australian market, in Europe, in Japan? So they do a lot of these, robustness checks in the papers. And at S&P Dow Jones Indices, we also kind of run something similar where, like, for example, in the dividend research that some of the paper I published, I look at like how the dividend kind of strategy or indices performed in different markets. And there are some consistency across, right? The higher yield and potentially the yield traps, right? So some of the result is just surprisingly consistent, whether you look at the very long history, like almost maybe 100 years of the historical data in the US versus, like if I run a similar study in Japan with a bit shorter history or in other markets. So I think, and back to my previous one on like factor research, right? The consistencies across the market is something that kind of surprising on one side, but also build some of the confidence in terms of the product design, in terms of index design. And maybe lastly, I want to touch on a little bit like the index provider's role, right? If you think about the application of the indices in the financial market, right? So the indices can really used for, I think, three main purposes in today's financial market. The first one is benchmark. So in terms of benchmark, and if you think about like when you, if you want to understand how the U.S. market performed last night, you wake up, you look at your phone, how the S&P 500, how the Dow Jones Industrial Average performed last night, right? And same thing here in Australia, you look at S&P ASX 200 to understand, how the Australian market performed. So it's really used to measure the performance of certain asset classes, and that's what the index originally kind of was designed for, right, as a benchmark. But beyond that, right, you see that now index can be used as the underlying of the passively managed vehicles like, ETFs, index mutual funds, etc., to replicate or track the performance. And that became a very common usage these days. Thirdly, which some might not be well known, is like you can use as the underlying for derivative contracts as well, right? So like options, futures, to gain the exposure to the assets without directly investing into the asset itself. So you can gain this access through this very liquid derivative market. And you can use those derivative instruments like for hedging, risk management, trading purposes. So these, I would say, like, those three are the main applications these days in the indices. But one thing that people might misunderstand is what we don't do, right? As an index provider, we are not asset management. We do not make market predictions. We do not do individual security research or equity research. We don't give investment advice because we are not asset management. And in the way that if you think about an index, you can't directly invest in this index, right? But what you can do is you invest in the type of the products that we mentioned, that licensed our indices to underlie those products. So there's a differentiation between, the index itself versus product. So I think that a lot of people might kind of misunderstood.
Yeah. So we have a lot of ETF providers that come on the show. Both like from here in Australia, but globally, like a lot of ETF providers come on the show. And they are benchmarked, oftentimes different products, different funds are benchmarked to S&P Dow Jones Indices, right?
Yeah.
How does your team work with ETF providers?
So indeed, ETF providers, ETF issuers, they are a very important market segment that we work with. But maybe I take a step back. If you think about, the different market participants we work with, not only ETF issuers, but also exchanges, right? I mentioned about our collaboration with the ASX, investment banks, insurance, asset owners. Like there are a variety of market participants that we collaborate in this space. But in the ETF space, indeed, so as an index provider, right, we publish and calculate indices. But as I mentioned before, indexes itself, they are not investable. So an ETF issuer or a fund manager, they can create investment vehicles so to replicate the performance of an index. So or sometimes they call we passively tracking, the index, but it's really to replicate the performance. And in order to do that, so the investment vehicle, they would need a proper licensing from the index provider to use, our intellectual property behind those indices.
Yeah.
So if you think about the evolvement of the ETF industry, so the first index-linked investment product back then was launched 1976. It was tracking the S&P 500, right?
Yeah.
And then the first ETF was actually launched in Canada back in the 1990. The first ETF was in Canada. The first ETF tracked the S&P 500 was launched in 1993.
I didn't know it was Canada.
Yeah, so if you go up on Google, find ask or ChatGPT, whatever, ask what is the first ETF, when is it created? I believe it was 1990 in Canada. Yeah. Right. But then the first ETF, tracked the S&P 500, it was launched in 1993. And then since then, over the past 32 years, this industry really grew substantially in terms of assets under management. I personally think it will probably be one of the most significant innovation in the financial industry over the past century. If you think about all the things going on and how that kind of reshifted the whole industry. According to ETFGI research, the global ETF assets under management, I think, crossed 17 trillion as of August. Last night, I got a message. I think it was over 18 trillion. As of September end. The product wise, there are almost 15,000 products globally with 25,000 something listings across, I would say more than 800 providers and, 80 different exchanges in 50, 60, maybe 60 plus countries. So, it's like a global kind of ecosystem now if you look at industry. And we, at S&P Dow Jones Indices, we actually track the assets, so benchmarked and indexed to S&P Dow Jones Indices, so our products. And our most report shows there were more than 1,200 ETFs that are tracking indices published by S&P Dow Jones Indices with an estimate of $13 trillion of assets indexed or against the S&P 500.
Wow.
Yeah, as of last year in December. And there's also in Australia about $100 billion of assets that's indexed against the S&P ASX, index family. And a couple of weeks ago, actually, we witnessed the 400th ETF listed on the ASX, and that ETF is actually also using one of our indices. So it's a very fast evolving now, quite mature but still growing in terms of ETFs in terms of the in terms of the size of the assets, in the space, and maybe a little bit on like if you think about what's driving this, right? This from 30 years ago, the first one, to today, like trillions of the assets. It really has this thing to do with the active to passive, right? And you mentioned about SPIVA. Some of the old days market beta, it kind of evolves to become like smart beta, right? Yeah. Some of thematics, multi-assets. Traditionally, like it's difficult to evaluate the active managers' performance. If you think about back in the 50s, 60s, it's hard to tell where the excess return comes from. But with the research and a lot of the factor side of the things, you can now understand like with market beta exposures, is the performance also has some exposure to like value, to momentum, to quality. If you control for those like systematic factor exposures, what else you get, right, from that excess returns? So in the way that it's really kind of democratizing the traditional active strategies to make them more accessible to broad market participants through an systematic, transparent, and cost-efficient manner. And SPIVA report kind of speaks to some of this active-passive debate. Next time my colleague here, I think she will be happy to talk about that. We ran SPIVA report for a very long time. So SPIVA stands for S&P Index versus Active, SPIVA. Yep. And we published that report for like 20 plus years. As you say, it's very popular here too. Yep. Looking at the most recent one on the 10-year basis, more than 80% of the Australian equity in the general fund category kind of failed to beat the S&P ASX 200. So essentially, one of the key takeaway there is like it's quite difficult to, over the very long time, consistently, beating the underlying benchmark. But I'll leave it to my colleagues next time.
Yeah. But I think people would be listening to this thinking how much depth goes into constructing these benchmarks. You mentioned before the idea of product, which in our lingo is like a financial product or something like that. But for you specifically, what do you mean by product? When we say you're a product manager, what is that?
Yes, so the product is an index, right? I'm index product manager. But so the index itself, right, it includes IP and the data. So the IP is the intellectual property, which includes things like the index name, the brand, the index methodology, and we'll talk about it in a little bit. The data side includes things like index historical levels, the constituents weights, etc. So you get the IP side and the data side of things.
Yeah.
But it's really, I think the basic question is like, what is an index? Right? We talk about indices, we talk about applications, but what exactly is it? So index it's a financial kind of, I would say it's a numerical score that based on inputs, such as different kind of asset prices, fundamental information. So based on some inputs from the financial market, and it can be used to track the performance of a group of assets in a standardized way. So it typically, like indices measure, the performance of a basket of securities, and it intended to replicate a certain area of the market, right? So that's kind of a bit of standard definition of what index is. And if you think about our standard index product offerings in terms of the lineups, equities, fixed income, commodities, real assets, multi-assets, and now we are building indices like in the option-based indices, private markets, digital assets, benchmarks. So these, the areas of different asset classes or different type of so-called strategies, you can use an indexing approach, right, to build the products. So within the equity, so I focus on, factors and dividends as we talk about. Yeah. So I launched like factors and dividend indices for different markets. Taking here in Australia, for example, right, so my product coverage, it really focused on the factor index suite of the S&P ASX index family, and which includes, dividend, it's a big one, value, momentum, low volatility, quality. And we are also working on some of the, multi-factor research in this space too. So some of the recent indices in Australia that I worked on launching, includes like the S&P ASX 200 high dividend, the S&P ASX 200 GARP, grows at a reasonable price. So that's like, Australia domestic equity space, and also launched like some global indices like the S&P World X Australia GARP, the S&P World X Australia High Yield Dividend Aristocrat Select. So different type of, factor-based, dividend-based indices, but outside of Australia. So these indices, they are unlike the broad-based benchmark or the market indices. So these indices typically come with kind of certain type of strategy focus, factor focus, and they are often used as benchmarks or underlines for the ETFs to replicate the performance or passively tracking the performance.
It's fascinating because if people are familiar with the ETFs that track those indices you mentioned, they would understand now where that original kind of thing comes from. You know, it's you and the team. Can you walk us through the design process? So, like you said, you've worked on a lot of these here in Australia, even, but also globally. What does that design process look like?
Yeah, that's almost like my role as a product manager, right? So if you think about our day-to-days and what we do, the first, I think it comes down to like we identify the gaps in the marketplace. We think about, because there are lots of indices, there are lots of ETFs already out there. But we think about like, is there any gaps in the index products in this market? Take an example that we launched a Factor 2.0 campaign, things like last year. And what that is about is that if you look at the traditional single factors I mentioned about, value, momentum, quality, a lot of those indices were launched like 10 plus years ago. And the usage, the application has been quite mature in the marketplace. But over the past decade, there is a growing kind of demand or research or findings based on how the market evolves. And some of the new kind of matrix, like free cash flow, for example, like some of the things that's less well known or not commonly used in the previous traditional single factors. But we found there is a potential gap in the marketplace. So then we initiate, can we design an index around this idea? So that's what we did on the Factor 2.0 campaign. So we designed kind of a series of new differentiated innovative factor indices. And then, once you have an idea, it comes down to research. Like you look at the historical data, you look at, like the literature reviews. Is there any like empirical studies that people have done before to certain matrix? We also work very close with a lot of internal stakeholders to design the index concept, to look at like what's a hypothetical index history would looks like. So that comes down to a lot of data crunching. And at the same time, we consistently kind of receive the market feedback to those ideas, to those kind of, data crunching outputs. And we kind of work closely internally and externally to kind of assess the market demand of certain ideas and concepts. And if it's proven to be like, oh, there's a room for this, like there is a gap indeed for this, we launch the index. So once the index is live, you will have like, every day, basically end of day calculations and those things going on. It became like a live index. And then I talk about applications, right? You look at like how those things can be used. Some might be used as benchmarks, underlying for ETFs. Some might be using for derivatives instruments. So once the index goes live, you look at, the downstream application side. And that's not even the end of it, right? We continuously evolve the index methodologies through like public consultations. There might be, market evolve and new things comes up and market give us feedback. And we also consistently kind of looking at, is the index methodology achieving the objective? So we kind of, monitor looking at this closely. So overall, if you think about the whole process from, the gap, the kind of analysis, research to like launching to everything, I call it like index product lifecycle management. If you think about, this way, because like every index as a product have its own life cycles, right? So that's kind of essentially like my role as a product manager.
Yeah. So identify those gaps and then go through that life cycle. It's really interesting to hear from your side because you're the one that is trying to identify these gaps, right? Because we all think in our heads like, well, maybe there's a strategy that I'm missing. Maybe there's some data that I could use as a signal or something like this. But you and the team have the capabilities to actually explore that. For you then, what are some of the more important aspects or characteristics to consider when designing a strategy?
Or an index, I think one thing that might be overlooked is index methodology and the index governance side. Okay. So what that means is, S&P Dow Jones Indices, we have an index committee. We actually have many different committees oversee different kind of index families. And the index committees, these serve as the index governance body that oversee the design, the maintenance, and the publication of our indices. So the index committee, they seek to ensure that, these indices are maintained in accordance to the relative methodologies. The index committee also review the methodologies to ensure that they continue to achieve their stated index objectives, and they oversee any changes, in the index and the methodology itself. So we actually have a very clear kind of documentation in terms of how the index governance framework looks like at S&P Dow Jones Indices, and it's on our website, including this separation of the commercial and analytical rules. So from the index governance analytical side, they make independent assessment, right? So that's very important, actually. If you think about, there are many indices out there, but the index methodology in terms of the accessibility and the transparency. So as I said, the index is a basket of securities to measure performance of a group of asset securities. One thing behind this is it's important to understand how this basket is constructed, right? And this comes down to the index methodology, all right? If you have an index, are you able to find the index methodology on the website? And from the index methodology book, are you able to understand step by step, how is it constructed?
Yeah.
I think, with looking at that, you understand how the basket of securities is constructed, how the index is constructed. And that kind of tells you, when you look at the levels, the movement of the index, you kind of say, these are the reasons. Yeah, these are the reasons. It's almost like you have a menu. Yeah. Right, and then using the menu, you understand how this thing is constructed. So at S&P Dow Jones Indices, we really try to make our index methodology accessible and clear. So if you look at our standard indexes and the ones I mentioned, like S&P, ASX 200, GARP, for example, there's a website for it. Anyone can open the website. There's a fact sheet. There's an index methodology that anyone can go there and take a look. How is this constructed step by step? So I think this is very important, because the transparency behind the index construction, I think nowadays with so many different indices out there, it's very important to consider and understand, the construction itself. Yeah.
It's I didn't even think about the separation between kind of the research team and actually building the index, and then the commercialization of that being separate, because you could understand how having those together maybe causes issues down the line, right? You mentioned GARP there, and that kind of the growth at a reasonable price being a factor. And here in Australia, as you would know, Jason, people love income. We have a tax system that's very favorable, and a lot of Australians rely on income from the share market in particular to get their income in retirement and so on and so forth. What makes an effective yield-oriented index?
Yeah. So first, again, index is not investable. So index wouldn't generate income itself, right?
Yeah, exactly.
So it's really like the if you look at the yield or the in the equity dividend yield, fixed income coupons. We also have this covered call indices, which is like in the derivative space, by selling the options, selling the call options. So the hypothetical kind of income generation reflected in the indices, it can come from different sources. But I think here in Australia, especially in the equity space, a lot of people talk about the dividend focused, the dividend yield focused indices. S&P Dow Jones Indices, we are the leader in this space in the dividend indices. If you look at globally in the dividend ETFs, about 50% of the global dividend ETFs assets that are tracking the S&P Dow Jones Indices, our dividend indices. Right. And in the US, so if you look at the largest 10 dividend ETFs in the US, 5 out of the 10, they're actually, tracking our dividend indices. So we have a variety of dividend index product offerings. And the reason why we are able to achieve so is that there are different types of dividend indices out there. So the first is the high yield, right? So that's what I think most Australian market participants are familiar with. So like S&P ASX 200 high dividend index. It focuses on basically selecting the companies with the highest dividend yield. So it's a very much like a yield focused construction from the S&P ASX 200. But the second is the dividend aristocrats. So the dividend aristocrats, sometimes people think of as a dividend growth strategies, like S&P 500 dividend aristocrats. So this index selects the companies that consecutively grow dividend for at least 25 years.
Yeah.
25 years, year over year, growing dividend from the S&P 500. So this year actually marks the 20th anniversary of the launch of the S&P 500 Dividend Aristocrats. So it was launched back in 2005, 20 years ago. And then the third is the integration of the dividend to some of the other factors. And take one example, the Dow Jones US Dividend 100. So this index is not like a typical yield or aristocrats type of index construction. So the ETFs that tracks the Dow Jones US Dividend 100 in terms of assets, it passed $70 billion of the assets, and it's one of the fastest growing ETF in the dividend space. So this index actually has a bit of high yield focus, but also integrates other factors like return on equity, dividend growth, cash flow to debt, right? Dividend yield. So a couple of things together as a composite matrix. So that's kind of the integration with, dividend and other factors. If you look at the dividend yield reflects in the S&P 500 to the S&P 500 high dividend, there is an spectrum. So the S&P 500 dividend yield recently is about 1.2%. The S&P 500 high dividend in terms of dividend yield is about 4.7%. So between 1.2 to 4.7, you can see, this spectrum. And the different dividend indices I mentioned, like S&P 500 Dividend Aristocrats, Dow Jones US Dividend 100, their dividend yield level, it kind of falls between. So the S&P 500 Dividend Aristocrats is probably 2 point something based on some the recent data. Dow Jones US Dividend 100 is probably 3 point something. So, in this spectrum, from 1% to like 4 point something, in the middle, there's like, other dividend indices that kind of fill in the gap, but those comes with different construction with a bit of different focus, right? So that's kind of what, kind of the yield focused, strategy or dividend indices looks like in our offerings. Yeah.
So you mentioned Dividend Aristocrats, high yield.
Right.
It's really popular indices around the world. And Australians know them well as well. The Dividend Aristocrat Index, it doesn't actually have as high of a yield as some of the others. Yeah. So why is that specifically?
Yeah, so I mentioned about this, spectrum, right? So it again comes down to index construction and index methodology. So for the S&P 500 Dividend Aristocrats, because the focus is on the consistently growing dividend over a long time, more than 25 years, so this index constituents are also equal weighted. So they are not like dividend yield weighted. So, a lot of things are devils in the details. So the dividend yield level is not necessarily as high as if you compare to S&P 500 high dividend, right? Or S&P 500 low volatility high dividend. So some of the more like dividend yield focused. But think about, companies that are able to grow dividend consecutively for more than 25 years, what that means, right? This implies some of the long-term, like long-standing companies with a history of resilient operations, very strong financial performance across market cycles, 25 years plus, right? And there's a bit of quality flavor, honestly, in this index design, instead of just a purely yield-driven. A purely yield-driven has a lot more exposure towards value.
Yep.
But then this one, if you look at like consecutively growing dividend 25 plus years, you get a bit of like, quality flavor in it. And in addition, the dividend growth versus like a dividend yield is a bit different. So a company that are able to grow dividend, typically there is this thing called like dividend signal effect, right? So for publicly listed companies, increasing of dividend versus like drop dividend, suspending dividend, these have some of signal effect to the capital markets. And for companies that consistently grow dividend year over year, 25 plus years, that signaling effect to the street, right, to the capital markets, it just says something behind, the construction and the constituents behind the index. And I think in short, if you look at the dividend yield of the S&P 500 Dividend Aristocrats, as you have a dividend name, the dividend yield is still higher than S&P 500.
Yeah. Right.
So you compare to the underlying benchmark, the S&P 500, you still get like a bit boost of the dividend yield, but you get a lot more, based on the construction, based on this 25 plus years of consistently growing dividend. So that's why, the dividend aristocrats index family, we have many different indices around this. It's kind of not a typical high yield focus, like a lot of, kind of Australian market participants familiar with, but more like consistently dividend growth.
It makes a lot of sense what you just said about the signaling. Like if a company's cutting its dividend, what does that signal to investors versus increasing a dividend, even if it's slowly over time? That's it. Kind of it's for, I imagine for a lot of investors, it's kind of reassuring when a company does that. We have a saying here, which is Australia for income, global for growth. Do you think that statement holds up when you look across the world? Do you think that statement holds up?
So first of all, I don't quite agree with Australia for income, global for growth, because if you think about growth and income strategies or indices, they exist in both worlds, right?
Yeah.
So in Australia, we have been calculating the S&P ASX 200 growth index for many, many years. And on the 10-year backtest, it actually outperformed the S&P ASX 200. So not to say that recently, I mentioned about we launched the S&P ASX 200 GARP last year. And indeed, Australia is one of the high yield markets in the world, right? But the growth indices, they also exist in this marketplace, be it like a pure growth, style type of strategy or indices, or the GARP type of indices. On the other side, so growth indices have performed quite well outside of Australia. So when we launched, the S&P ASX 200 GARP, we also launched S&P World ex-Australia GARP, so the non-Australia developed market version. It performed quite well since index went live, but income is also super relevant, right, for the global markets. If you think about, again, here income refers specifically to the equity space dividend yield. Based on the paper we recently published, so if you look at the three largest markets that contributed to the global pool of the dividend, and these markets are US, China, and Japan. The total dividend of the Australian market only accounts for about 5% in the global dividend pool. And this is because of the size of the companies, right? If you look at the market cap in the US, in China, in Japan,
for sure, that makes
right?
sense.
So if you look at on the total dividend amount perspective, so Australia market is high in terms of the dividend yield, but at the same time, its yield kind of trending down. If you look at the dividend yield level in the S&P ASX 200 over the past like 2-3 years. But in terms of total dividend amount, it's only about 5% based on our recent research. So globally, there are about $500 billion of assets in the ETF, in the dividend related ETFs. And if you look at in Australia, the magnitude of the assets in the ETF, in the dividend ETF space. So I think the dividend or income strategy, it's also clearly a very big theme outside of Australia.
Yeah.
So I think, growth and income or dividend focus, it also exists outside of the Australia, like, they exist here in Australian markets too. So I mentioned about, dividend aristocrats. So we actually launched the S&P World ex-Australia High Yield Dividend Aristocrats Select Index this year. So this is a, again, dividend aristocrats index, but to measure the markets outside of Australia, and it provides a new tool for the Australian market participants to better understand, some of the dividend aristocrats characteristics in the global markets.
Yeah, it makes a lot of sense. And also the sheer size of global markets. Like even if you took US, China, Japan, Australia is by far very, very small in that group.
In the total market cap.
Yeah. I'd like to just maybe ask you for some of your own personal kind of reflection questions, if I will. What's the name of an index that you've personally worked on and launched recently?
Yeah, that's a good one. We recently launched an index called Dow Jones US High Dividend 10. I call it like the modern version of Dogs of the Dow.
Yeah, Dogs of the Dow.
You might hear Dogs of the Dow. So Dogs of the Dow, I call it like the OG of the dividend indices or strategies. It dates back to the 60s, 70s, right? Yeah. So Michael O'Higgins, I think, he came up with this Dogs of the Dow. Essentially what it does is like look at the Dow Jones Industrial Average, select the top 10 stocks based on the dividend yield. And, very simple construction, and you have a 10 stock kind of basket. And in the research or the numbers that Mike O'Higgins kind of ran, it performed quite well in the 70s, 80s. And the modern version I refer to here is that it's a similar construction. So it's also looking at Dow Jones Industrial Average. But the way we look at the dividend yield is we look at the dividend yield from the dividend forecasting perspective.
Yeah.
So I mentioned about we have S&P Global Market Intelligence, which is our sister company, and they have this product or data set called dividend forecasting. So they have a group of analysts who research dividend payment, do like dividend forecasting on the global markets. So we are actually fortunate to leverage that research and data sets to construct this index. So even though the concept is very simple, it's like one sentence of the index construction, but the data behind this, that's why I call it it's a modernized version. It's a quite interesting project we worked on, if you think about a very legacy concept, but like integrating with some of the data innovation, in the broad S&P Global. So that's one I launched recently. Yeah.
I read a lot of investing books from the 80s and 90s and even the 2000s, which mentioned the dogs of the Dow. And then you kind of put that modern flavor on it where you look forward. Makes a lot of sense. So I've got two more questions for you. One is one that I ask everyone that's on the show for the first time, Jason, which is if you could go back in time and tell yourself one thing about investing, business, career, whatever the case may be, what would you say?
That's a good one. I would say that if I were look back telling the younger version of myself, learn more about math, statistics, computer science as much as I could.
Really?
Yeah. Because if you think about, so I did a computational finance kind of program in the States, but I think that's just way not enough. Because if you look at the AI booming, in the industry, like not just in the finance investment, but across the board, a lot of the machine learning, AI, NLP, there's a lot of foundations based on the math, the computer science and statistics, right? And AI adoption has just been a priority across the board. It is a priority for us, a priority for many, market participants. And if you look at specifically like at workplace, like at S&P Global, a couple of things we are doing on the AI space. One is, to create new indices that are AI related. So in terms of thematic indices, if you think about the S&P Kensho AI enablers, so that's an index we launched a couple of years ago. That's using like a AI-driven, NLP-driven type of approach to construct the index that focus on the AI theme. So that's kind of AI-related index offerings, and we have a lot more on this topic. And also like using the AI in the index construction, right? So we just launched an index called S&P 500 3 AI Sector Rotator Index. And this index is building some of the AI machine learning kind of algorithms in its index construction. So like applying, the technology and the development into the index construction, into the index methodologies. And thirdly is really like looking at how can AI enable our operational process, the efficiencies, right? And there are like every different steps in the whole operation side across S&P Global, like looking into this and to improve, the efficiency of how we operate. But if you think about like these are in the application side, but in the, bottom line, a lot of these algorithms and everything is like math, stats, computer science. For sure. So if I were to think about, I would probably do more like statistics class and computer science class, just to kind of better prep me for the, 10, 20 years later, because this thing is going to be there, right?
Yeah,
it's just
huge.
The technology revolution on the AI space is just going to be there. And I wish I can have a better understanding of some of the underneath stuff.
Yeah.
Right. Yeah.
Yeah, that makes sense. Actually, coming in today, I was hoping you would mention AI because of the unique place that you are in your career, but also S&P Global as a big business. All the data that's there, all the intelligence that's there, it's kind of like the fuse of that is like really fascinating for
data
AI
is
application.
Engine.
Yeah. So this is a question that Mitch always asks when he's on the podcast of guests. He says, if he likes for food tips because he's a big foodie. So he says he wanted me to ask, I'm coming to Beijing,
okay,
and we're going out to eat.
Yeah.
Where are you taking me and what are we having?
I think you will probably guess I'll take you to a Peking duck place.
Yeah.
Because it's a very famous dish. A lot of people coming to Beijing, that's their like first dinner.
Yeah.
So there are a couple of good big Peking duck places that I know, but The first meal I think I'll take you is a different place. It's called King's Joy.
King's Joy.
The name of the restaurant is called King's Joy. It's a vegan restaurant. It's a vegan restaurant. It's a Michelin star restaurant. I think it was probably the first vegan restaurant that ever got a Michelin 3-star, and it's in Beijing.
Huh.
Yeah, many people don't know. And it's like the restaurant itself is in the courthouse. I see you are now start to Googling, right?
Yeah, keep
Look
my
it
notes.
up and you can find its dishes. It's like every dish is like an art piece, and it's all like vegan. It's in the courtyard that's like very old, but it redecorated. And then the next door, it was in this like 300, 400-year-old Lama temple. Huh. So you're in the center of the Beijing, like it was pretty close to the city center. And, it was vegan restaurants, very sustainable, very tasty, great environment, very private. So I think that will be my first meal with you. Yeah. And then afterwards, next day we can go to Peking Duck because we have some, vegan food last night, right? So that will be my option.
Yeah, great. I like it. That's amazing. I've just got the photos up here.
Yeah, it looks great, right?
King's Joy, yeah.
Yes.
Well, if I ever get there, that's going to be at the top of my list. So thank you, Jason. But
of course,
really appreciate you taking the time out of your busy schedule to join us here on the show and share all these insights.
Yeah, my pleasure. Thank you, Owen.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.